everyone, a very good morning. You're watching Buy Now, Sell Now on ET Now. I'm Mubina Kapasi. Quick look at what the markets are up to this Tuesday morning. And well, we had started off with quite a bit of momentum. We sustained about the 11,500, but we've slipped off from there. In fact, now we're left with gains of just about 0.25% for the Nifty, and the Sensex is gaining roughly 0.2%. Pharma is the sector in focus because it's among the top performers. Today's top Nifty gainers as well are the likes of Dr. Reddy's, Cipla, Sun Pharma. But that's essentially what we are tracking for you as we just about are near the day's low for the equity markets, as PSU banks and the realty indices are weighing in on the benchmarks. Moving on, more stocks and news. Here is an exclusive interaction we had with Infosys. CEO says that the company is working with a margin guidance band of 21 to 23%. They expect more partnerships with large firms in US and Europe. They're continuing with acquisitions and investments in the digital space, and the overall pricing is quite stable at this stage. And the rush for rupees continues. The NBFC pack, or the sector rather, has raised $3.4 billion amid the coronavirus crisis. Getting you more excerpts from conversations with corporate India. India Bulls Housing has said that they've managed to raise $100 million, and the promoter holding now has come down to 22% post the issue. So there's an 8% equity dilution. There's, according to them, plenty of room to grow as well as gain market share. And continuing with a series of interesting conversations, Yes Bank tells ET Now that the liability franchise is shaping up well as their deposit growth came in at 11% in Q1. They expect to see this momentum continue for the rest of FY21 as well. They've in fact managed to also, this was the big headline, remember, managed to pay back 50,000 crore rupees to the RBI ahead of time. And not just that, Yes Bank is saying that they are managing to open 60,000 accounts every month. We're seeing green shoots in the retail and MSME sector. And keeping it with banks, the government may infuse 20,000 crore rupees in India's public sector banks. A parliamentary nod is currently awaited. Kumar Mangalam Birla, chairman of the Aditya Birla Group, says the Grasim is operating at 80% of pre-COVID capacity. And in the world of films, Bollywood, or the Indian film industry, has requested the government for permission to reopen, with, of course, a sharp focus on theatres to reopen. So keep an eye out for PVR and INOX. Okay, well, there you have it. Those will be all the top stories that we are tracking for you today on ET Now. But with that, let me go across to my colleague Varun Hiremath, who joins in right now on the show. Hi, Varun. Morning. Well, we've slipped off quite considerably, from, the high point of the day, but nevertheless, still sitting on some small gains today for the benchmarks.
Right, Mubina. Rightly pointed out. But before we do a market check, let's just address the BNSN quiz for this morning. We've been putting out a question every day, and it seems that a lot of you viewers are interested in answering them. So today's question: which of the following technology stocks has the highest 5-year compounded profit growth? Simply put, which company has delivered the highest profit growth over the last 5 years? They're technology companies we're highlighting today. So Tata Elxsi, IndiaMart, Tech Mahindra, Coforge, that's NIIT Tech, recently rebranded. So these are your options. Do tweet to us on the ET Now handle, and if your answer is one of the correct ones, you'll be featured on our handle and here on the show as well. That'll happen at 11:45. With that being said, we're now ready to go on and look at the markets. It seems to be a clear day of Pharma performing, if at all, Bank Nifty performing, if at all, and small caps and mid caps really leading the charge. So that's a trend that we've been seeing. Apart from banking, that's been missing. Pharma, small cap, mid cap have been doing well. Today, the banking stocks pulling some of their weight. Particularly the winners from the Nifty: Cipla, Dr. Reddy's, Sun Pharma, Bajaj Finance, and an NTPC. On the losing side, Eicher Motor, HDFC Life, ITC, Tech M, and Titan. The breadth pretty much 50-50. 25 of the 50 are advancing and 25 of the 50 are declining. So I guess you can say it's quite a muted day for the markets and no clear trend visible just yet. With that being said, let's now move on also and get you the BNSN stock cloud. We have 10 stocks that are moving today for their respective reasons, beginning with a logistics company that we don't talk about too often, Aegis Logistics. UBS has an upgrade with a target of 260, so that's making it in there today. We then have ICICI Bank, which has been allowed to maintain a higher shareholding percentage in some subsidiaries. That's there as well. PSU banks, because there's a recap currently going on and 20,000 crores might come in this week for them. NBFCs are also in there today because they've raised cumulatively around $3.4 billion since the onset of the COVID pandemic. You then have PVR and Inox, two film stocks that are begging the government to let them get SOPs for reopening because they're really suffering. PVR just put out a horrible set of numbers yesterday, barely any revenue and obviously a considerable loss. You then have Divis from the AGM, which gave some really bullish positive commentary about how the company is benefiting from all the China issues and the API push. You then have Apollo Hospitals and HUDCO, both weak result candidates. The loss was pretty decent in both of them and something that's got those counters in focus. Then HCL Tech, on the back of that mid-Q2 update, some really positive commentary. This morning, brokerages are also seeming very upbeat on an HCL Tech. But let's talk fundamentals and technicals with two guests who are joining us. We have Kunal Bothra and Saurabh Jain with us this morning. Good morning, and thank you both for taking out the time. Kunal, coming to you first, what's catching your eye in terms of specific stocks? What's your high-risk, low-risk idea for today?
So, good morning, Varun. Specifically, so I expect that the index could continue to remain in this consolidation or in this a bit of choppiness, for the next couple of days at least. Some of the data points in the open interest are also not very encouraging, for the futures traders, and which is why I believe that this kind of choppiness and this kind of an intraday volatility would continue for the indices for the next couple of days. So, two ideas which I would recommend. One on the low risk front, and that's about CESC. Now the stock is clearly showing signs of a breakout on the daily charts about that 675 plus mark where it's currently trading. It's trading about its 200 moving averages as well. And looking at the trend behavior of the stock, it's relatively a slow moving kind of a name, and which is why I would categorize this purely as a low risk trade on CESC. Would recommend this as a buy. Targets to be kept at 700, stop loss at 665. The second would be a high risk trade, and that would be from the large cap front. It's a buy on Bharti Airtel. Now, the stock has been dragging lower from those 535, 550 levels which it tested, I think 2 weeks back to 475, which it tested yesterday. But yesterday on the data front, when the stock was at this 480 to 475 band, there was a huge chunk of volumes which happened. Now, when I looked at the open interest data for Bharti Airtel, there was a shoot up of open interest of more than 6,000, 7,000 contracts on Bharti Airtel. Look at the price action today. The stock, rather than seeing a sell-off, a follow-through selling, it's actually seeing a mild bit of a bounce. So you can probably categorize that the volumes which transpired at 480 levels yesterday could be more of the buy volumes which have happened for Bharti Airtel, which is why I would like to initiate a contra buy call, and which is why I put this in a high risk category. A buy on Bharti Airtel, a contra buy, targets of 500 plus, and stop loss at 466.
All right, that's of course Kunal Bothra, his technical take on the markets. Saurabh Jain, over to you then. At this point of time, like we've been flagging off as well, our markets lack some sort of direction. No such triggers, that could perhaps lead the way for the markets. Most of the time, we seem to be aping the Dow. So what would be your take, and how would you form an opinion on the equity markets? And if you could as well share with us your high risk and low risk ideas for our viewers.
I think after the SEBI circular, there is happening in the mid-cap and small-cap stocks, but as of now, we are very optimistic on the pharmaceutical sector and the IT sector. I think these are the sectors which will play for long. And today's pick is my first pick, which is low risk from pharmaceutical sector. I'll be giving a buy on the Dr. Reddy. If you look at the Dr. Reddy, it is a presence in both global generic API segment and proprietary products. They are reviving the business which they have acquired from the Vocard. They have also also filed various ANDAs in the US global markets. They have also done licensing tie-ups for the 2 COVID drugs. If you look at the numbers they have posted, they were actually beaten the streets, and they have seen good amount of growth, approximately 80-90% in the API segment. So we are quite bullish on the pharmaceutical sector, and that Dr. Reddy also, and we are keeping a target of about 50 to 100. The next stock is from the utility. The stock which we like from the utilities is Torrent Power. It is present in the entire value chain. I mean, it is in the generation, distribution, and in full value chain. If you look at the numbers, they have posted good set of numbers, about 35% kind of a growth in the profitability. They have been able to increase their margins because of higher contribution from the green energy plants that they have. They have approximately 4,000 megawatt capacity. So all in all, we are keeping a target of approximately 370 rupees.
Right, that's of course, Saurabh Jain talking about his high risk as well as low risk idea. Pharma is something that he's definitely pretty optimistic about. Well, this is the show where we also help you out with your questions and queries. So let's get straight to that. Remember, you can always tweet to us with your stock related questions on Buy Now, Sell Now, and we'll get them answered. First up, we have a question coming in from Sanya Mehra from Mumbai. She says she's bought 1,000 shares of Bharti Airtel at 550 rupees and wants to know she must add, hold or sell. Well, definitely a stock in focus, a stock in news. But Kunal, of course, now that this entire bit around AGR is behind the stock, and I guess Saurabh as well would love to get in your opinion on that. Do you believe that now, Airtel will be purely a story where one could bet on based on things like Indian demographics, or the fact that mobile internet is still comparatively a little underpenetrated in India, but that's of course more a question for Saurabh. So Kunal, let me also get in your take on the technicals from a more shorter term perspective.
Well, I believe that Bharti Airtel has been a slave of the data front, at least on the not on the data, mobile data, but on the FNO data, particularly Mobina, because I remember very clearly when the stock was at those 585, 600 levels, almost a month and a half back, there was a dramatic change in the open interest data, and there was a sharp reduction in the open interest for Bharti Airtel, which happened when the stock corrected from that 600 levels to 585. In just a matter of 10-15 rupees, there was a change of data, which now, when you look at it retrospectively, it indicates that there was strong unwinding, or there was a very good unwinding which happened for Bharti Airtel. Now, when the stock is at those 475, 480 zone, and I was pointing out that the data indicates now that the open interest is now almost at a 2-month high for Bharti Airtel, which I think is an indication that traders who have probably exited Bharti Airtel at those high levels of 585, they are the ones which are looking to buy back again the stock at those lower levels. So I think at 475, 480 levels, I believe Bharti Airtel is an attractive buy. If you bought at 550, that's your initial average, that's your initial cost. Then I believe at 475, 480 zone, you should definitely look to average further. Being your cost price lower, the stock has a tendency of going into those odd periods of correction when the market tends to outperform. And whenever the markets tend to be in a corrective phase or in a downtrend, Bharti Airtel stands to outperform. So there is this dual nature of the stock price, completely different than the Nifty behavior. But I think in that regards, Bharti Airtel should be bought into at current levels. I believe, at least from a short-term view, I would expect a 500 to 510 kind of a target on Bharti Airtel.
Okay, well, Saurabh, over to you then. Like I was saying earlier, do you think that the prospects for Bharti Airtel look good? And of course, not to mention, do you think it has the worth then to go up against the Jio, which has any which ways managed to position itself very, very strongly, grabbing a whole host of Airtel subscribers over to its side?
I think we have to look at telecom space in a more constructive way. If you look at the competition intensity is decreasing. We have seen few hikes in 2019 December also. The 4G customer base is also increasing. The staggered payment pertaining to AGR liability is also positive for the company, for the Bharti Airtel. I mean, they have already paid 13,000 odd crore and 5,000 more for that liability. So we are looking the operational flexibility for the company is increasing, and in our view, I think it is a long way to go. But I think the street is more inclined to see how far the companies are able to increase their average revenue per user, which is not happening very fast the way the market anticipated. And I think the fall was related to that also, and some restructuring is also there in MSCI index. I think that is the reason for which we have seen a fall. Overall, I think we are positive for the telecom industry and on the Bharti Airtel.
Okay, thanks for that, Saurabh. Let's get on to query number 2. We have an email from Rahul Roya of Delhi. Bought 1,000 shares of RBL Bank at 210 recently. Heard financials might be in trouble going forward. Should I sell, hold, or possibly even add? So Kunal, on the RBL chart, do you think that there could be a better entry point coming in the near future, or do you just stay put? Do you add? What do you think?
I think you can stay put over here, but if you're looking to add, then I think current zone is not the best of the zones to add RBL Bank, because it has this tendency to fluctuate in a band of 160 to around 200 to 205, 210. I think, if I'm not wrong, was the previous swing high for RBL Bank. So it managed to surpass above that band, but it failed to convincingly sustain, and which is why you saw some selling pressure emerging. So the stock is trying to indicate that it's wanting to consolidate in this band of 160 to 200 for some more time. And if you're looking to average further on the lower end, then I believe averaging at 160 levels could be a much better trade. And I think if you've held on from 210 levels and the stock is at 180 plus 180 or sub 180 levels, then I believe at current levels it looks to be slight bit more weaker. So it depends on your strategy which you're looking to buy. If you're looking to average further, then I believe wait for that 160, 165 zone. I think those are good support levels for RBL Bank, and I think that is where you should look to average further. But if you're looking to do it from a very, very short term view, then I believe you can probably look to exit at current levels of 180 or 185 range, and then look to buy back again once the stock comes back to 160, 165.
Okay, thanks for that, Kunal. So, Saurabh, Kunal's pretty much of the opinion that you could see 160 bucks on RBL anytime in the near future, and then the risk reward is more favorable. Do you concur? Or do you think that given the kind of investors RBL's had, the kind of money it's been able to raise, and the brand that it has, that it should be worth more?
I think market is more concerned about its book because it has high exposure towards the MSME, microfinance and retail loans, and moreover it has some exposure to the NBFCs. Previously, the market was concerned because of the exposure of the bank towards Cafe Coffee Day. So I think on the growth front, there seems to be no concern. They have been able to increase their net interest margin. They have been able to reduce their cost of funds and increase on the yield on advances. But I think the concerns pertaining to their exposure to the NBFCs, microfinance is very much there, which is keeping lid on the stock price. I think the stock may continue to remain in pressure. I think if you want to be in the banking sector, better to be with the larger players like Axis or maybe Kotak.
Okay, thanks for that, Saurabh. So I guess both our experts are of the opinion that there's a lot better banks you can look at if you are indeed interested in financials. Let's leave RBL Bank alone for now. Thank you. Let's move on to our next query. That is from Siddharth Patel from Surat. And he's got 1,000 shares of Granules, which he's bought at 350. So again, one trend I'm seeing with the queries that are coming in lately, they've all been buyers who've recently bought perhaps towards the end of the last really sharp spike in markets. 350 bucks for Granule is expensive. So Kunal, looking at the chart, do you think one might book out right now and wait for a fall, or can you stay invested here?
Definitely. If you've bought at 350 levels, Stock is at 370. Look at the way the stock has run up in this 6 months period over the last 1 year. So I think from 80 levels, 2019 made somewhere 80, 85 levels. The stock is now at 370. So these are exponential returns, almost a 4.5x or 5x returns in a matter of 1.5 odd year for a stock like Granules. Just look at it in the very, very short term charts, and I look at the monthly charts for Granules. The last 4 months have been spectacular. So the stock has doubled or more than doubled in this last 4 months, from 160 levels to 380. Now there are some technical indicators which we keep a watch upon. When these stocks get into an overbought zone. So if these stocks enter into an overbought zone at those levels, in fact, we recommend clients to try and exit the stocks at every rises. So I think Granules is now coming into that kind of a territory. Last 4 months, the indicators have got back into an overbought territory, and as now the stock has moved along from those 160, 200 levels to now 380 plus. The stock has confirmed some strong readings or some overbought readings on the monthly chart. So these are not encouraging signs for someone who's looking to buy these stocks at the thick of the very high momentum. In fact, these are the zones where you should look to book out profits over here and trim your holdings significantly. So I would be of the specific view that I think these are levels where you should look to book out your profits on Granules. And if the stock comes back to say a 280, 300 levels, I think that could be a comfortable territory for you to try and look to enter again, provided all the dynamics, fundamentals, etc. remains similar.
Okay, so that's Kunal's recommendation on Granules. Saurabh, at the beginning of the show, you mentioned that you are optimistic on the pharma space. How do you look at Granules? I mean, for the long term, do you think that that's a stock you would pick out?
Yeah, I mean, the company is doing extremely well. The drugs like metformin, paracetamol, ibuprofen has done exceedingly well for the company in COVID-19 times. If you see the numbers, the company is able to grow its revenue by more than 20%, and there is a growth of about 30% in the bottom line. Recently, they have got approval for one of the drug which is related to hyperactivity disorder. They'll be manufacturing their drug in the Virginia, in the USA. They have approximately 30 NDA approvals from the USA. 28, I think, two out of which 2 are tentative. I think there are some buzz also that the promoters may wants to exit the business, considering the high valuation that these CRAMS and API businesses are getting, and there are some buzz that they have hired Kotak also, for that matter. Overall, I think I am positive on the company. The outlook is quite positive, so one can stay put in the counter.
Okay, there you have it. That's the word then coming in on a Granules India, which, by the way, as well has seen quite a rally. But unfortunately for our viewer, he has bought it at a bit of a high price. Kunal, just want to get in your word then on the Midcap index. In our Chartbuster segment, you mentioned that this is one index that's at a crucial juncture. Plus, with the entire SEBI circular, it's once again shown the spotlight on the Midcap index. So, if you could walk our viewers through what's your thinking process behind this index.
Absolutely, Mubina. So, what I was discussing earlier, and then the charts, if you can show the charts on the screen. The Midcap index is at a very, very crucial juncture. Now, these are 3 years or 4 years of chart patterns for the Midcap index. Look at the way the stock, the index had actually rallied from 2016 to 2018. There was a beautiful period of 2 years, 3 years, where the Midcap index flourished quite well, and a lot of the Midcap stocks did pretty well in that regards. Now, a stock and an asset class generally tends to replicate the same behavior. There is a rhythmic price action which we generally see into similar asset classes. So what you saw in 2016 to 18, you've seen the same behavior replicating for the Midcap index, and now it's into a reverse direction where the index is actually making a pattern of lower highs and lower lows. Now, specifically, the resistance line which I have marked on the Midcap index, look at the way the resistance line has behaved in this 3 years of downtrend for the Midcap index. 4 attempts, and all those 4 attempts earlier failed. This is the 5th attempt towards breaking that resistance trend line. Now, what has changed for Midcap index is the volume patterns. Now, if you can see the yellow circle which I have marked both on the price and the volume front, there has been a complete shift towards volumes for mid-cap index, and that indicates that this time is completely different than what the index has been doing in the last 2 years or 3 years of this downtrend, because the volumes have started to participate higher. The index is very close towards the fifth time a breakout, and consistent attempt towards breaking of a resistance line eventually leads to a breakout. So I believe whether it's the SEBI rule, whether it's how the mid caps have positioned the last 5-6 months, I believe an eventual breakout should happen for the mid cap index. Maybe the confirmation could probably be due over the next 1 or 2 months. But post this confirmation, I would expect that this 3 years of downtrend, which once gets confirmed on the end side, you would now expect at least a bull market or a bull trend which could last minimum at least 1.5 years, if not more. So I think the mid caps are just at the cusp of a very strong breakout, and I believe a confirmation of this will probably happen over the next couple of months. And if that happens, it could be due for at least a 1 to 1.5 years of uptrend. So, which is why I believe that potential for mid caps to outperform could be far more significant provided this breakout sustains for the index.
Okay, so that was a very interesting analysis by Kunal, and we all hope that it comes true. We're all waiting for the mid caps and small caps to finally shine after this long pause they've taken. But from mid caps, now let's focus on small cap and the rally it has been witnessing. SEBI's multi-cap rejig has caused a stir in the small cap index and stocks. Ever since the announcement, we had a chat with Safir Anand, strategist and investor. Here's what he thinks about the small cap bets. Listen in.
Well, I would increase my allocation in small and mid cap, irrespective of whether the circular had come or not, because with every passing day, we have a little bit more of certainty vis-a-vis, whether these businesses are surviving or not. And obviously, I'm trying to pick the ones that I feel are going to survive. The second part of the thought process is going to be that let's not forget that a lot of people in large caps have massively underperformed the market. When you call some of the very smart investors on your show, though they always talk about how their life was changed by owning some small cap or mid cap and how it ended up being a multi-bagger. How the retail is infatuated by the potential of a small company to become a mid company and a mid company to become large, and that cycle has never changed. How the AMFI is actually being told to reclassify, and right now the reclassification hasn't even happened. But people are doing number crunching based upon an assumption of the current status, which may itself change. For example, they may be QIPs, and therefore the market cap of a lot of these companies may change. Some of them, for example, are moved up just today, whether it is sentiment or whatever reason. So if effectively the mid cap and the small cap universe itself has gone up maybe 2% in its market cap, and if it goes up and it sustains, then the dynamics change. There are going to be a lot of new offerings. There will be a divestment by the government, and a lot of that requires some of those companies are terrific in terms of their business mode, in terms of their dividend, in terms of their cash flows, etc. So I would look at it from a holistic purpose, and like I said, I won't go and buy an index per se or just buy every single company. But in the quality names, I think there will be an increase of allocation.
Welcome back. You're watching Buy Now, Sell Now on ET Now. Just a reminder for all our avid market watchers, in our BNSN quiz segment, where we, of course, test your market knowledge and your ability to spot the D-Street trends. Today's question is, well, it's something to do with, once again, technology stocks, who's there, the flavor of this week. But which of the technology stocks has the highest 5-year compounded profit growth? The options we gave you are Tata Elxsi, India Mart, Tech Mahindra, or Coforge, which earlier was called as NIIT. So tweet to us on our Twitter handle @BuyNowSellNow, and you'll get a chance to watch your name and Twitter handle appear right here on Buy Now Sell Now in precisely 15 odd minutes from now. So put on your thinking cap, start tweeting to us, and we will be revealing who our BNSN quiz champions for today are in just a couple of minutes from now. Well, keeping it with technology then, the Nifty IT has posted the best day since the 15th of July, and it's in fact now trading at a lifetime high. In fact, even some mid-cap names like an Infosys is trading at record highs. So what's the road ahead? Jayesh Khinani joins us on our ET Now Insight segment.
Yesterday, we saw that the Nifty IT index posted the best single day that we've had since 15th of July. And there were a lot of high-flying stocks, including HCL Technologies as well as TCS, which became India's second 9 lakh crore company by market capitalization. But with that, what happened was the Nifty IT index now comfortably trades above what the analysts were estimating it to. And the gap between the analyst expectation versus the actual price is now a healthy 7%, which is the maximum gap that we have seen in over a year now. And that is on the higher side, which means that the analysts' expected fair value price is lower than what the actual price of the Nifty IT index is. And that is courtesy a lot of stocks that have exceeded expectations as well. Let's have a look at those stocks as well. The entire Nifty IT basket, if you have a look, Infosys is the only stock that trades below its expected analyst target price. Rest all stocks trade above their target price. The likes of Wipro, Coforge, InfoEdge, Mindtree, as well as TCS, they have exceeded expectations by more than 10 to 15% each. That's the kind of runaway rally that I'm referring to in the IT stocks. But that has a negative side as well, because when the prices go up, the valuations also start to increase. So if you have a look at the current estimated PE of the IT index, that stands at about 23 times, which is on the higher side as compared to its long-term average of 16 to 17 times. It is also higher than the one standard deviation above, which is 19 times, and also above the 2 standard deviation price, which is 22 times. The 3 standard deviations that has been achieved only once, which stands at about 25x. So interesting to see if we can go back to those levels, but definitely valuations look a little bit stretched with the current value.
So that, Jayesh, IT stocks really have been leading the charge. But earlier in the day, switching gears a little bit, we caught up with market veterans Varun Daga and Charandeep Singh of Girik Capital to understand whether this bull run in IT can really sustain. They also mentioned about their top picks at the fund currently. Let's listen in.
A lot of our companies are, so to speak, digital ready. You know, if you look at many of them, they are great companies. They have superb leadership, great management, no governance issues. They are true leaders with accelerating earnings. But you know what all of these companies have done over the years? They have invested far in advance of not knowing a pandemic was coming. They've invested in great IT. They've invested in great HR personnel. They've invested in ensuring that they're always digital proof, IT enabled and technology ready, such that they can take leadership when the tough times come. So it's very easy for such companies to take market share at a time like this. The large is Darwinian. The large get larger. And I think this is a time when, unfortunately or fortunately, that is happening. So I think great observation on your part that, yes, a lot of the platforms that we are invested in are digital ready. You know, as far as you said...
Okay, well, let's address some Q1 numbers, which are, yes, still trickling in. Raymond delivered its first quarter numbers. Lockdown has obviously impacted its performance. Yeah, we essentially just want to also get in a sense of how is this entire shift from China working out? Is it benefiting them? And also, of course, as we are unlocking, what sort of trends are they witnessing? So joining us on the okay, well, before we do that, let's now connect on, let's just sort of talk about what we spoke on the Money Show yesterday, and it's obviously got to do with multi-cap funds. Your multi-cap funds now will look a little different from here on. So we spoke to Kaustubh Belapurkar, the Director Fund Research with Morningstar Investment Advisor, as he shares his view on what should the current holders of multi-cap funds do.
The manager wants to kind of maintain the strategy that he's been running for a while, then the option really for them is to exit the multi-cap strategy, and they would either move the fund into a category which is closest aligned to how they've been managing the strategy in the past, But remember that SEBI also has a guideline that for most categories, you're allowed only one fund per category. So if they already have a fund in that category, which they think is the best fit, then they would eventually, need to merge the two strategies, into one single fund as per SEBI's guidelines. The other option, obviously, is for them is to actually go and, meet the guidelines as per SEBI's put down, which is 25, 25, 25 in large, mid, and small. So that's a decision I think obviously managers are right now in consultation with the various stakeholders, considering what their investment mandate has been in the past and what is probably in the best interest of investors is what they're going to kind of try to get at, which is the best possible solution in the change in the amendment of the guidelines and the regulation.
Let's say for individuals. Okay, let's now connect with then the management of Raymond to talk about their Q1 numbers, what exactly they went through in this lockdown quarter. We have with us Amit Agarwal, the Group CFO of the company. Amit, thanks so much for joining in. To start with, of course, no surprises, that your performance as well has been hit because of the lockdown. We saw an EBITDA loss. What are you observing now? I mean, what essentially is your strategy to turn things around, turn the operating performance around? Is cost rationalization something that you are assiduously working on?
So we all know that the first quarter is largely impacted, as you rightly pointed out, due to pandemic, which we had extended lockdowns. And the whole channel of distribution, be it retail, franchisee, wholesale network, everything was not in a position to operate their shops. And that is clearly reflected in the revenue numbers. So like you and me have not walked up to the store to buy anything. That clearly reflects upon that we have not been able to deliver the sales, which we should consider in a normal course of business. So this quarter has not been a normal course of business. But what you rightly pointed out is on the cost rationalization. If you look at our numbers, we have clearly razor-sharp focus on our deep drive on the cost rationalization. Clearly, if our OPEX cost, if you look at it, that we have been able to reduce by 275 crores, by approximately 50% compared to the fourth quarter numbers. And this ranges for employment cost, rental savings, advertisement, sales promotion, commission, every single line item which we saw, we said that this needs to be reviewed. We did not leave anything stone unturned in terms of reviewing the cost. And every cost was looked at it based on starting afresh, that whether you really need to incur this cost or not. And based on that, we carved out clearly the cost savings, and which is very clearly reflected with the 50% compared to the fourth quarter. Now, the other big focus for us in this quarter we have seen also is on the working capital management, that we have been able to demonstrate that our net working capital is lower by over 300 crores, which was basically driven on the collections from customers. Now, as per the ethos of the Raymond, what we do also is take care of our stakeholders who are the extended credit channels, which would be the wholesalers, the franchisee network. We have extended some credit terms to these channel partners as they have not been also able to sell and collect cash. So for us, I think the two big focus has been in this quarter is primarily on the OPEX cost reduction and the working capital management. Now, as far as we have told earlier also, in this year, compared to the fiscal 20, we are looking at somewhere in the range of 30 to 33% reduction in the OPEX cost. And this is something which we continue to drive upon. And we are very, very focused that this is something which we have already backed in and which is with us.
All right, thanks for that, sir. And also in terms of operations, what's the status of your manufacturing facilities and how many of your stores are currently operational? Also, are you seeing footfalls in these stores, and have they increased by any chance in the recent months?
Let me first talk about the stores, because that is the unique proposition which Raymond has distributed its stores over 600 plus cities, which I think is an unparalleled. And as we speak today, when we talk about our 95% of our TRS and the EBOs are operational. Clearly, the TRS sales have picked up quite decent, and we are seeing almost at pre-COVID levels reaching up to 50 to 55%. And these sales are clearly the secondary sales where the customers are coming forward into the store and picking up the fabric or the apparel from our TRS stores. As you all know very well that many of the TRS stores being distributed over 630 cities has got between tier 1 to tier 6 cities, and they don't tend to be, every one of these stores do not tend to be in the malls. So they tend to be in the high streets, but standalone shops where people are more comfortable to walk in and pick up the goods from there. As far as EBOs are concerned, they are primarily between tier 1 to tier 4 cities, and there many of the stores are also in the malls. And an apparel buying which is through the EBO stores is generally tends to happen over the weekend, and we all know till mid-August most of the malls were not working, and if they had been working, many cities had seen the weekend lockdowns also there. So if you are not going over the weekend to pick up this your apparel, you would see a lower sales. Therefore, I see very clearly a distinct change which is happening, that the weekends have opened up, and we are seeing an encouraging response in these aspects. And now we are just on the knocking door for the festive season. And with the festive season, onset of the festive season with Durga Puja, Diwali, and followed by a strong, we believe, is a wedding season, because a lot of summer weddings which could be there, which has been pushed out as there were less celebrations during the lockdown phase. So we see clearly a phase where the sales would continue to pick up. Obviously, we are living in a very uncertain environment. If things do change dramatically in terms of the lockdowns, which we don't believe, then obviously things would be different. But as it looks like, it's more a question of opening up than locking it down.
Mr. Agarwal, while you just did touch upon some of the points that I'm going to ask you right now, could you just shed, a clearer light on the overall demand scenario right now, as well as the consumer sentiment, especially because work from home has become a norm now. So how is the demand for formal shirts, office ties, office shirts, and in general just office wear also shaped up? And then by when can we expect this returning to normalcy?
There are two things. One, when we say work from home, so work from home is sort of, we had no option but to resort to a work from home. As you were locked down, you can't say that I will not do anything. So that was a kind of via media which was taken up to say ki work from home. But consistently we believe that it is a phenomena which is going to be a short-lived. It is not going to be a permanent phenomena. Second thing, we as a company have been very progressive, and we have launched also a lot of fashion in terms of work from home wear for the period which we are continuing. And we have also strengthened our online presence through our own myraymond.com so that people can start going on and buying on through line. But as far as the formal wear is concerned, at the end of the day, it is going to be there. The weddings would happen, and India is a market where weddings are being celebrated, and we as Indians believe a lot in celebrations. So this whole thing, be it our suitings and shirtings and the good quality, which is a differentiated product which we have, will be always good in demand. Second thing, we also need to understand that at this juncture, there are people who were maybe in the past buying 4 shirts. He may be interested to buy today 1 shirt, and then he wants to buy a good quality branded product and not get to 4 shirts maybe where he has few other choices, but he wants today to go for more a branded product. One more thing I think it's important to understand is that today in terms of this whole Chinese imports which used to happen, which used to be cheap, not a good quality material, sometimes not qualifying wool but may not be fully wool, but those kind of things have also come down, and therefore the Indian customers are becoming more and more to see that they want to buy Indian products. And we should also not forget that the agriculture economy, which has done very, very well in this season, is also pushing the demand. And we are seeing very good demand coming back in tier 3 to tier 6 cities, where people are coming back to the stores. Our average ticket value of the purchase have moved up also substantially.
All right. Amit, the fact is that we are seeing fewer cases, fewer lockdown restrictions in tier 2 and tier 3 and tier 4 towns. So how has demand been in these areas compared to metros?
Again, in terms of tier 4 to 6, we see the demand is almost like 75 to 80%. But obviously the proportion of the total sales out of these cities won't be significantly higher. So you are seeing a good demand pickup, but the real big sales in terms of the larger volumes obviously comes from the tier 1 to tier 3 cities. So we are happy to see the good movement in the tier 4 to tier 6 cities. And as I mentioned to you, see, we have the unique strength of our channel distribution, which is unparalleled. With 20,000 point of sale, you are present in every small city, even if it requires a bit of a fabric to be purchased, we are there very much. We have the decent amount of inventory at all the store levels so that people can pick it up. Second thing, with our range, we cater to a range from a 300 rupee meter to a 3 lakh rupee meter. So every walk of life person who can...
All right, thanks for that, Mr. Agarwal. Great chatting with you this morning and getting perspective on what exactly is going on at Raymond. But switching gears a little bit back to the BNSN quiz, it's time to reveal the winners and the answer. So we gave you 4 options, and the question that we asked you today was, which of the following technology stocks has the highest 5-year compounded profit growth? Tata Elxsi, IndiaMart, Tech Mahindra, or Coforge? I am happy to announce that we have 3 winners today who all guessed the correct answer, which is IndiaMart. And if you have any doubts about what the growth rates are, you can look at the stock price, and it seems to be reflecting the profit growth and maybe more. So Chetali Keni, Om Rathod, and Kasula Vamsi Krishna. These are our 3 winners on BNSN Quiz Connect for today. Thank you so much for giving in your answers, and please keep them coming. There's going to be a quiz question coming your way every single day. On that note, time for a quick break here on Buy Now, Sell Now. Plenty lined up. Don't go anywhere. So welcome back to Buy Now, Sell Now. Speaking exclusively to ET Now, Infosys CEO Salil Parekh said the demand is strong on the digital and automation side, and that the company has a great pipeline of large deals. We get you that exclusive later on in the show, but here's a quick excerpt.
We'll be even more robust with our margins. So I feel comfortable that in that sense, the investments we made in the first couple of years when I started are behind us. We are now working with this margin guidance band, which is 21 to 23%. And all of the activities we're doing for building capabilities, reskilling, come from this operating margin band. It's not any extra investments that we're looking for. I think it's incredible to have Nandan with us, with me, with the company. He's an incredible visionary, and he spends a lot of time, as much as is needed. Whenever I need some guidance and help, I reach out to him. But he also has a deep knowledge of what's going on in the technology world, how some of these digital transformation journeys are working. So the involvement is really very, very good, very positive. And he also has a clear view on the strategic direction that we should take as a company. So it's fantastic to work with him.
Okay, well, moving on in our Rich Mantra segment, we caught up with market veteran Saurabh Mukherjee and, of course, global guru Mark Faber, who shared his views on how and tips on how you as well could get rich. Listen in.
Just like Nestle dominates baby milk powder and Asian Paints dominates paints, similarly, say Garware Technical Fibers dominates the global market for commercial fishing nets. Right? They have, I think, more than 50% market share globally in commercial fishing nets. Commercial fishing nets are an essential commodity for Norwegian fishermen and Japanese fishermen and Australian fishermen. And Garware Technical Fibers is their chosen vendor. Right? So if you buy the dominance of Garware Technical Fibers, and there's a whole bunch of reasons why over the last 20 years, Vayu Garware from his Pune operation has been able to build this fabulous franchise. But if you buy the underlying barriers to entry that Vayu Garware and his firm have built, then obviously as the world recovers from the pandemic, and our country also recovers from the pandemic.
Well, I think if you really want to be rich, you have to work a lot, whatever that may be. Number two, instead of posting your picture on Facebook 3 times a day, I would go and learn something and study. Whether that study includes getting skills at being a good carpenter, electrician, or...
Completely out of time here on Buy Now, Sell Now. Thank you so much for tuning in. Keep it with ET Now. Markets at noon coming up next.